Welcome back. Today we have a quick and fun video on how you can legally not pay any capital gains taxes ever on your real estate. Usually when you own an asset and it goes up in value and you go to sell it, you pay what are called capital gains taxes. They're either short-term or long-term. If they're short-term, they're usually taxed like ordinary income, which means you're often paying between 30 to 50% in taxes on those short-term gains. So when you go to flip real estate, it can get really expensive really fast. Long-term capital gains, or owning an asset for more than a year and then selling it, are usually significantly reduced, oftentimes between 15 and 25%, just depending on which state you live in as well. For example, if your federal rate is 15%, but you live in a state like California, you might be paying 25% on even long-term capital gains. So how do we prevent that? How do we prevent ever paying a dime of capital gains taxes on real estate, and is it legal? First of all, absolutely, it's 100% legal, and it's pretty dang easy to do with the exception of option number 3. But let's go into the number 1 and number 2 option, then we'll talk about option number 3. Method number 1, the homeowner's exemption. The homeowner's exemption is when you're able to legally exclude $250,000 in gains if you're single, or $500,000 in gains if you're married on the sale of a property. So let's do an example of this. First of all, you need to know what a basis is. A basis is usually defined by what you bought the property for, plus some little additions or capital improvements. But let's just keep it very simple. Let's say you bought a property for $250,000. and then you and your wife decide to sell the property a few years later, and you sell it for $750,000. Because there is a $500,000 spread between your basis of $250,000 and your sales price of $750,000, which you don't get taxed on selling costs anyway, so you kind of get to offset those anyway, so you're even more in the clear. But anyway, simple math, that difference is $500,000, that's your max possible gain, and the federal government lets you exclude 100% of that first $500,000 in gains if you lived in the property for 2 out of the last 5 years. That doesn't have to be the most recent 2 years either. You could live there for 2 years, then you could move, and as long as you sell it before another 3 years go by, where that 5-year period ends, that's okay. You got your 2 years here, as long as you sell it before that 5-year period ends, you're golden. You get that $500,000 tax-free. Just awesome! If you're not married, you could really only sell the property for up to $500,000 because you only get a $250,000 benefit. Now there are some adjustments to this. Let's say you bought the property for $250,000. You lived there for those first 2 years, but then you rented it for 2 years and then sold it. So you bought it for $250,000. Now you rented it for 2 years and you depreciated the property, which means you told the government the value of the property declined, and you took a paper tax write-off of $25,000 a year. So now all of a sudden, your basis went from $250,000 down to $200,000. So if you went to sell it for $750,000, that's a $550,000 spread. Again, we're not considering selling costs here, which you don't pay taxes on anyway. You now have a taxable gain of $750,000 minus $200,000 minus the $500,000 you get free of $50,000. So that might mean you'd pay $7,500 to $15,000 in taxes, depending on your situation. So your basis can actually go down and end up costing you money in the future when you depreciate a property. But your basis can also go up. So say you bought a property for $150,000. And now you put $100,000 of capital improvements into it, like a new roof, electrical system, whatever, other things that you capitalize or spread over the life of the property for $100,000. Now your basis went from that approximate purchase price of $150,000 to $250,000 because you spent $100,000 in capital improvements. So now again, if you sell the house for $750,000, no taxes. Now keep in mind, if you sell a house for $750,000, I sort of alluded to this, but you might even have selling costs of about $50,000. So that gives you another offsetting kind of buffer, where money that you spent to get the property ready for sale, say you put in a new kitchen before selling it, that all comes off the top. So you can kind of work your tax numbers both ways. Unless you're depreciating the property like crazy, then it's kind of like your basis is falling and this number stays. Now, let's say you messed up and you waited until year 6 or whatever. You could no longer take advantage of that homeowner's exclusion, but you rented the property out and you were thinking to yourself, I'm gonna owe taxes if I sell it, but I really want to sell it, I want to buy something else. That's okay. You can do what's called a 1031 tax deferred exchange. 1031 is just the chapter of the IRS code that says you can do a like-kind exchange, which means that if you exchange or sell one rental property for another rental property of greater value, you can transfer that basis over and never pay taxes on the difference. So let's do an example of that. Let's say you sold that $250,000 property that you bought, and your basis was $250,000. And let's just ignore depreciation for a second. Your basis was $250,000. You wanted to sell it for $750,000, but you didn't have the homeowner's exemption. That's a $500,000 potential gain that you'd be taxed on, which could be like $100,000 in taxes. And you're thinking to yourself, oh my gosh, I don't want to give $100,000 in taxes away, that's crazy. But I really want to sell this property because it's a single family and I want a Grant Cardone my life, I want a 10X, and I want a 10plex. I want to get a $2 million 10plex. So you sell the property for $750,000. You're going to buy that $2 million property. And that $500,000 of gain is going to get catapulted into the $2 million property you bought. So if you bought that $2 million property for $2 million, and then you sold it for $2 million, you would think, oh, well, that's a break even. I'm not going to pay taxes on that. No. Now you have to pay the taxes on that property you deferred your taxes on, that first one. You're essentially transferring or delaying the tax liability from that first sale, that $500,000, to that 10-unit apartment building. Now let's say you sold that 10-unit apartment building for $1.5. You lost $500,000. Well, now you can eradicate the tax liability you had from the first one. But you wouldn't want to sell at a loss anyway. The best thing you can do is just continue to 1031 exchange. You get that $2 million property, then you're going to exchange to a 3, a 4, or 5. Who cares? It could be you 1031 from a $50,000 property into a $100,000, $200,000, $300,000 property. Just keep catapulting those tax liabilities up through the system of the 1031 exchange, and you never pay taxes. So method 1 and 2 are pretty simple. There are obviously complications to this, selling cost depreciation. You have to have an exchange accommodator, which basically means you have to pay somebody to hold your money if you do an exchange, because as soon as you touch it, it becomes taxable. It's a lot of other little complicating things, but if you get the gist of this, you'll see that there are legitimate ways you can never pay taxes on your real estate gains, which is awesome. Now, number 3. This is by far the hardest one, and one that I don't recommend you take advantage of, hopefully not anytime soon, at least. Let's set number 3 up by example. Let's say you have 1031 your entire life, and you have $10 million of properties, and $9 million of that is all taxable gains. That sucks. That's a lot of money you'd have to pay taxes on if you just wanted to cash out. Well, here's the thing. You died. When you die, and you should always talk to a CPA or attorney about this, you very often get a stepped up tax basis, or rather your children or heirs get a stepped up tax basis, which means that if you bought $10 million of property for $1 million, and you have $9 million of gains that you've accrued throughout your entire life or sort of put off by 1031 exchanging or prevented paying these taxes, the day you die, that $1 million basis becomes a $10 million basis, and all that tax liability goes poof, gone. So your children never pay taxes on that difference. Now, it's very important, again, talk to a CPA attorney about taking title correctly to make sure that you can take advantage of a stepped-up basis. There are many different forms of taking title: community property with rights of survivorship, joint tenancy, tenants in common, or taking title in a trust. These are all various different ways that have a bunch of different tax implications, so you really want to check out the details of those. But very, very important, think about this. Everybody should have a will, an estate plan, or a trust. They're not that hard to do. In fact, a lot of people would get mad at me for saying it, but I think if you're a younger person, you could kind of go on like NOLO and do a quick little will yourself or something like that just to have something. Obviously, later in life, it's a really good idea to actually sit down with professionals, and maybe even earlier if you have things to lose, to get things set up correctly so that your heirs can take advantage of basically you having acquired all this wealth And then when you die, you give the government a big middle finger. Go, hey, you're not getting a dime of taxes from me. Of course, after a certain value, there are estate taxes that come in as well, which I don't know off the top of my head what that is, but at some point, whether it's $5 million or $10 million in net worth that you transfer to your heirs, you do have to start paying what's called a death tax or estate tax. Not super familiar with that. Right, let's just look it up really quick. Death tax. Okay. Death tax, which is sort of the derogatory name for it, or inheritance tax, which is the more formal name for it, or estate tax, which is the IRS definition for it, says that Congress made permanent an estate tax on estates in excess of $5 million at a rate of 40%. So maybe my $10 million example wasn't that great because that extra $5 million would be taxed pretty highly thanks to this death tax. But if you don't have $5 million in net worth, you could see how, in theory, you could never pay a dime of taxes on your gains. So really cool real estate vehicle to know, especially when you're alive. Take advantage of it. It is very neat that you can essentially defer your taxes either through the homeowners exclusion or the 1031 exchange system. Just keep catapulting them into other like-kind investments. And there are a lot of cool new ways you can continue to catapult these 1031 exchanges into things that are sort of like-kind. I'm seeing people take units and turn them into shares of a real estate investment trust, so where they're actually not even owning a building anymore, but they're still able to defer all of the gains that they had on that unit because they're still technically going into real estate. A lot of cool things there. Hope you enjoyed this video. Hope it was helpful, and dying is not tax advice.